Hi, good morning. Welcome to Vijay View. Today, let's see why interest rate as a factor is so dominant in equity investing and bond investing. The Dow Jones, the Nasdaq, all of the global indices are down nearly around 10 to 15% in the last fortnight. And the reason? There's going to be Fed rate hike in coming months. Why? Because the inflation is so high. Okay, why does this matter to equities? Why does this matter to the bond investing? The main reason why interest rate affects the equities is how they are being valued. The common valuation method which every investor uses is discounted cash flow, and one of the factors in that valuation method is the interest rate, that is the risk-free rate. So when a risk-free rate moves up from 5% to a 6% or 0% to 2%, as per the guidance given by the central banks across the globe for their country, the valuation takes a hit. Why? Because a small change in the discount factor will have a cascading impact in the present value of the future cash flows. So how does this affect the growth companies like Zomato, Paytm, or Nika, or the startup ecosystem? The reason is these companies don't make a free cash flow. The main drivers for their valuation is that in future they will be making this X amount of profit or X amount of revenue as the future cash flows. So when the discount rate, that is the interest rate, moves higher, the present value of their cash flows takes a knock. Thus, the valuation takes a hit. So how do we invest in these kind of scenarios? Pretty simple. Focus on the free cash flow companies with low debt and good dividend yield. So why does dividend yield matters? Because dividend yield is one of the simplest factor where an investor can say these cash flows are being transferred to the investors as a cash dividend. It clearly signifies that the promoter is willing to share his wealth with the investors as well. Okay, so how does this demand and supply works in this inflation? When the inflation and the prices shoot up, it's the duty of the Fed to cut down the inflation rate. So the only way, or one of the tools, the better tools or frequently used tools, is that they start raising the interest rates. This dampens the demand situation. It forces the consumer to forego the discretionary spends and focus only on the mandatory spends, as the amount which they have will be limited when compared to the low interest rate regime. For your information, for the last 10 years, the interest rate has hovered between 0 to 2% in US market. In Indian market, it has hovered between the 10-year GSEC is hovering between 5 to 11%. 11% is a very high interest rate regime, or 5% is a moderately low interest rate regime. And the big beneficiaries of these lowest interest rate regimes are the home loan buyers, where they are able to negotiate for a good deal of amount when compared to the other financial products. Okay, so will the banks benefit? It is a double-edged sword for bank. They might benefit in the initial stages in the treasury income, which they will start booking, while the deposit rates have already started to shoot up by 10 basis points by HDFC, Axis, ICICI. A rapid increase in interest rates will jeopardize the entire equity rally. So have a keen eye on which sector, which segment to focus in coming days, as the interest rate will play a havoc in the short-term investing. While in the long term, yes, they do create a good opportunities for the investors who are willing to carry it for a 20-year, 30-year period, of creating a huge wealth in this equity market. Second, when compared to bond market, wait for the budget numbers. The entire bond street is very keen to know how much this year's spend as well as fundraise is going to be. With the increasing cost of funds across the globe, it's a bit tricky even for the sovereign to raise money at a cheaper rate when compared to last year. If it does, yes, good. The 10-year GSEC might hover around 6 to 7%. But if the fundraising and the quantum of fund is much higher, it's going to create a havoc in the bond market as well, as the yield might shoot up pretty high when compared to the other yields. And on the other front, gold, yes, gold is a good sector, or good sector allocation is also required in the coming days. My suggestion, tilt a 10% allocation to gold so that you have a good hedge and expect outperformance of gold in coming 4-5 quarters. This is a view. I'm not a SEBI registered analyst, but these views are all my personal. Happy and safe investing. Thank you.